In 2025, Canada faces a pivotal choice between two contrasting economic strategies. One is a liberal, mixed economy approach, driven by active government investment in clean energy, technology, and sustainability initiatives. The other is a conservative, free market strategy centered on deregulation, broad tax cuts, expanded resource development, and fiscal restraint. This report provides a side-by-side evaluation of these strategies, examining their key features, intended goals, and potential impacts across time horizons. It also assesses each approach's strengths and weaknesses, public ideological reception, and resilience or vulnerabilities in the face of global economic trends and shocks. Finally, scenario analyses, such as global recession, commodity boom, technological disruption, and rising protectionism, are used to stress test the viability of both strategies before an overall impartial assessment is given, using the best available evidence as of 2025. To clarify the differences, let's look at the core features and objectives of the liberal mixed economy strategy versus the conservative free market strategy. The liberal approach embraces an active government role alongside markets, a mixed economy. Public investments target long-term societal goals like climate action and innovation, while leveraging the private sector. Government investment focuses on clean energy and green infrastructure. There is major public spending to accelerate the transition to a net-zero economy by 2050. For example, the federal government offers generous investment tax credits, 30% or more, for renewable energy projects, aiming to spur private sector co-investment. Infrastructure investments support electrification, new and updated power grids, EV charging, public transit, and climate resilience. Strategic funding in research and development supports emerging industries like AI, quantum, and biotech. Budget 2024 boosts research grants and talent development to ensure Canada leads in technologies like artificial intelligence. Skills training is a major pillar. Programs expand post-secondary funding and workforce upskilling to equip Canadians for clean economy and high-tech jobs. Regional equity is addressed through targeted programs and regional development agencies, with support spread across the country, from Atlantic Clean Power to Prairie Clean Tech and Northern Infrastructure. The conservative strategy takes a different path. It aggressively supports oil, gas, mining, and pipeline projects, aiming to unleash Canada's resource sector. Barriers to new energy infrastructure are removed, including repeals or streamlining of environmental laws, and establishing pre-approved corridors for pipelines and power lines. The goal is to boost exports of oil, gas, and minerals, positioning Canada as a reliable supplier and energy security leader. Broad-based tax relief is central. The proposed Bring It Home income tax cut of 15% would let the average worker keep approximately $900 more per year. Corporate and reinvestment tax cuts are also planned to attract investment and deter capital flight, particularly to lower tax jurisdictions like the USA. Deregulation efforts include cutting federal regulatory requirements by 25% and applying a 2-for-1 rule, scrapping 2 old regulations for every new one. There are fast-track approval systems with strict time limits, aiming to improve Canada's business climate. Fiscal restraint is a guiding principle. Government spending increase would be limited, budgets balanced over time, and any new spending offset by cuts elsewhere under a dollar-for-dollar law. Wasteful or ineffective programs would be eliminated to reduce deficits and debt. On climate, the Liberal strategy treats action as an economic imperative. Carbon pricing is upheld or strengthened nationwide, as a cornerstone of climate policy. The 2030 emissions reduction plan aims to cut emissions 40 to 45% below 2005 levels by 2030, on a path to net zero by 2050. Major investments in wind, solar, hydro, nuclear, and energy efficiency are framed as both environmental and economic, creating jobs while reducing future climate costs. Clean economy jobs are growing around 7% annually. The Conservative plan prioritizes energy expansion over emissions cuts. The federal carbon tax and emissions caps on oil and gas would be scrapped. The strategy leans on technological fixes like carbon capture and small modular reactors, rather than pricing or capping carbon. Advocates argue Canadian fossil fuels can be produced more cleanly than global alternatives, helping displace dirtier fuels, such as LNG replacing coal. Climate regulations are seen as red tape that raises business costs and would be rolled back. The Liberal strategy targets inclusive and innovative growth. Investments focus on clean tech, digital industries, and advanced manufacturing to create high-quality jobs and raise productivity. Infrastructure and retrofitting projects generate direct employment, while electric vehicle and battery manufacturing create tens of thousands of new jobs. By 2030, up to 300,000 new green jobs could be created, and by 2050, clean energy jobs could outnumber fossil fuel roles. Unemployment is kept low through retraining and labor market support. Moderate deficits are accepted in the near term to fund investments, while long-term debt to GDP is managed through growth and targeted revenues, such as pollution levies or taxes on top incomes. According to the Parliamentary Budget Office, Liberal fiscal projections already show deficits declining to less than 1% of GDP by 2026. The Conservative strategy emphasizes market-driven growth and affordability. Tax cuts put more money into consumers' hands and aim to attract skilled workers and investors, countering brain drain to the US. Deregulation and project approvals aim to unlock stalled resource investments worth billions. Trades and energy jobs grow quickly, alongside a housing employment boom. A cut in GST on new homes and 350,000 new trades apprenticeships support a surge in housing construction. The goal is to rebuild Canada's economy with strong job growth in oil fields, mines, pipelines, and related sectors. Budgets are to be balanced by the mid-2030s. Long-term debt is expected to fall, assuming strong private-led growth and spending restraint. Supporters argue that tax cuts may partly pay for themselves by broadening the tax base over time. Short-term projections from 2025 to 2030 suggest GDP growth under the Liberal plan would be 2.5 to 3% annually, powered by public investment. Confidence is strongest in renewables, AI, and health tech, though there are risks, like overheating sectors, execution delays, or underperforming returns. The Conservative strategy projects 2.2 to 2.8% growth from a resource and housing-led boom. Small business and industry sentiment is high, though capacity constraints, like labor shortages, pose challenges. Each strategy directs capital differently. The Liberal plan steers investment into clean tech, electrification, public transit, and innovation clusters, often crowding in private capital. Canada's climate leadership could attract impact investors and sovereign funds. The Conservative strategy channels capital into oil sands, LNG, uranium, and housing, enabled by deregulation. However, this may deter ESG-conscious investors or companies reliant on climate-aligned supply chains. On labor and wages, Liberal policies aim for high-skill employment, retraining, and productivity-driven wage growth. Conservative policies boost construction and energy sector jobs, with lower taxes spurring labor force participation. Average wage growth may lag in regions where productivity doesn't keep pace. Each approach also carries fiscal implications. The Liberal plan runs modest deficits of 1.5 to 2% of GDP, supported by targeted tax increases and justified as investment. National debt risk rises if GDP growth underperforms. The Conservative plan reaches balance faster, but risks remain, especially if tax cuts don't deliver expected revenue. Healthcare, education, and infrastructure funding may increasingly fall on provinces. In terms of global alignment, the Liberal Plan meets 2030 emissions targets and aligns well with US and EU climate rules. Canada plays a leadership role in UN climate finance and COP summits. Yet, backlash from oil-rich regions could grow. The Conservative plan increases emissions and could breach climate commitments, risking trade penalties under mechanisms like the EU carbon border adjustment. However, energy exports, especially LNG to Europe, may enhance Canada's strategic value. Looking ahead to the long-term outcomes between 2030 and 2055, each strategy charts a different future for Canada. The Liberal strategy envisions a transition toward a high-skill, clean energy-based economy. Exports are dominated by advanced manufacturing, artificial intelligence, biotechnology, electric vehicles, and renewable energy. There's potential for Canada to emerge as a global hub for climate-aligned industries and sustainable finance, including carbon markets and environmental, social, and governance (ESG) capital flows. A major challenge, however, is ensuring that workers retrained from old energy sectors, oil and gas, can secure long-term, stable employment in new industries. In contrast, the Conservative plan seeks to solidify Canada's role as a top exporter of fossil fuels and critical minerals. There is heavy investment in logistics and industrial infrastructure, especially in Western Canada. The risk lies in long-term fossil demand. If global markets shift away from carbon-based energy, this economic model may weaken. Additionally, underinvestment in emerging sectors like artificial intelligence or clean technologies could cost Canada its global competitiveness. From a social perspective, the Liberal path tends to support long-term income equality, expanded access to education, and inclusive programs. Greenhouse gas reductions lead to public health improvements, with fewer pollution-related illnesses. Greater government engagement during transition periods may help maintain civic trust. The Conservative approach offers lower taxes and potentially faster economic growth, boosting take-home incomes. However, regional disparities may widen, particularly if benefits concentrate in oil and resource-rich provinces. A more limited social safety net could leave vulnerable populations exposed. In terms of fiscal outcomes, the Liberal path depends heavily on maintaining strong growth. If that's achieved, debt to GDP could stabilize or even fall after 2040. New revenue streams from clean technology exports, carbon pricing, and royalties may improve long-term fiscal health. But if green industries underperform, legacy investment debts could weigh on future budgets. The Conservative strategy aims for balanced budgets by the mid-2030s. If global oil demand remains strong, public debt may decline faster, but falling energy revenues or climate-related infrastructure costs could pose future challenges. Comparing each strategy over time. In the immediate term, 0 to 2 years, the Liberal strategy benefits from strong stimulus and visible clean energy project launches, though deficits remain moderate. The Conservative plan delivers immediate tax relief and a boost in business confidence, though fiscal outcomes are uncertain. In the short term, 2 to 6 years, the Liberal strategy creates green job growth, earns global climate credibility, and expands retraining, though it carries upfront costs. The Conservative strategy sees a resource boom and housing expansion, but emissions increase and global trade friction could arise. In the long term, 10 to 30 years, the Liberal strategy supports a climate-aligned, diversified economy with a stable fiscal outlook if well managed. The Conservative model either sustains energy dominance or struggles if fossil demand declines. Its fiscal position may be strong, but it carries high climate and global competitiveness risks. Now, placing each plan in the context of global trends. Under green trade and regulatory regimes, the Liberal strategy has high resilience. It secures tariff protections and gains access to sustainable markets. The Conservative strategy is vulnerable. exposed to green tariffs such as the EU Carbon Border Adjustment Mechanism and ESG requirements from US trading partners. In periods of commodity price volatility, the liberal strategy benefits from a diversified economy, which can buffer against shocks. The conservative model has high-risk exposure. It thrives during booms but suffers in busts. Sensitive to price drops, often requiring assistance to avoid heavy job losses. Facing a technology sector disruption, especially in artificial intelligence, the liberal strategy is well prepared. It prioritizes talent development, research funding, and social transition support. The conservative plan enables rapid private sector adoption of AI through deregulation, but lacks strong worker protections and could see greater social problems with a disruption. During a global recession, the liberal strategy can use infrastructure spending, job programs, and green exports as counter-cyclical tools. However, public debt, due to interest rate hikes, could rise if the downturn is prolonged. The conservative approach has fewer social relief tools available due to budget constraints. Declining oil prices and reduced home construction could deepen the impact. So what does the data suggest? According to economic forecasts from the OECD, Conference Board of Canada, and Royal Bank climate reports, the viability of each strategy depends on how well Canada aligns with global shifts. If climate action, AI-led growth, and green trade blocs dominate, the liberal strategy appears more adaptable and resilient. If the global economy remains fossil fuel dependent, and capital mobility accelerates, the conservative strategy may yield stronger GDP growth and lower debt in the short to medium term. Yet, each strategy faces risks. The liberal path may rely too heavily on uncertain green tech returns. The conservative path could overexpose Canada to stranded assets, missed innovation, and trade isolation. Perhaps the best course is not a binary choice. If Canada can borrow elements from both, investing in clean innovation while ensuring fiscal discipline and energy independence, it may craft a hybrid model with maximum resilience. But based on current global trends and available evidence, the data leans slightly in favor of the liberal strategy in terms of global competitiveness, long-term viability, and economic transformation.